Chapter 6, Part 1, we're going to look at absorption costing versus variable costing. Okay, absorption costing is primarily for external reporting because all manufacturing-related costs, fixed and variable, are absorbed into the cost of the product, required by GAAP and IRS for external reporting. And direct materials, direct labor, and manufacturing overhead are treated as product costs. What we're doing here is when we use absorption costing, we cannot, let's see, what can we do? Play with it to see what happens if different things happen, because we have the cost behavior, i.e., if it is a variable cost, it's going to stay the same on a per unit basis, but it increases or decreases based on changes in production. Then we have the fixed costs, which remain the same within the relevant range, regardless of units produced. However, on a per unit basis, it reacts inversely to changes in production, which means that if production goes up, the average fixed cost goes down. And if production goes down, the average fixed cost goes up. This is what we use for traditional income statements. This is what we've learned in financial accounting. So we start with our sales, then we do our cost of goods sold, then we get our gross margin, we minus our selling, general, and administrative costs. And see, when you use this model, you really can't use it for future planning because it doesn't take into account cost behavior. So now we're going to look at an example so you can see what I mean. All right, here's our example, and as you can see from this, we're showing our selling, direct labor, and direct materials, and our variable operating expenses on a per unit basis because those remain the same regardless of the volume within the relevant range. And we're seeing in this example too that we have our fixed costs and we have our for operating and for overhead. So we also know that we have how many units we made and how many units we sold. So now what we're going to do is we're going to prepare an income statement using absorption costing. So here's our example again so you can see where I take the numbers from. So first what we're going to do is we know we sold 12,000 units. We made 16,000, but we only sold 12. So we're going to take 12,000 units times our unit price, right from the schedule of $65, and we know we made 780,000. Cost of goods sold, it's going to be our direct materials plus our direct labor on a per unit basis, which gives you $28 times the 12,000 units, and that tells you what our cost of goods sold is. And we also have to include our manufacturing overhead, and that's going to be $18. Now, how did we get that? We took our actual total overhead cost, and remember, or you're going to mess up on your homework, you divide by the units manufactured, not the units sold. Units manufactured, because the overhead applies to all the units made. So in this case, we get $18 per unit. And now we have a total for our cost of goods sold, which gives us our gross profit minus our variable operating expenses and our fixed portion of our operating expenses. And that's how we get operating income. Now, let's take a look at what is the product cost per unit under absorption. It's going to be our direct materials plus our direct labor plus our average overhead rate, and so we get 20 plus 8 plus 18 gives us $46. What is the ending balance inventory for absorption? It's going to be $46 times 16,000 made minus 12,000 sold. We have 4,000 units left, so we're going to take $46 times 184. Now, get those numbers again. These are all provided for you in the problem. So the first thing you always need to do whenever you're working a problem is figure out what information you need to use. And do not get confused with the made versus sold. Now, if they're the same, if you made as many as you sold, this is not an issue. But if they are different, then it's going to give you a difference in terms of the two methods you use, absorption versus variable. All right, so now what is cost of goods sold? That's going to be your, let's see, is that the question? Yeah, what is cost of goods sold? That's going to be your $552,000. And what is your operating income? It's $184,000. So now we can go on to the variable costing. Now, variable costing, this can only be used for internal reporting. It cannot be used for external reporting because this is a tool that you can use in managerial accounting to assess changes in production, i.e. somebody comes to you and they say, hey, if they're within the relevant range, i.e. you have a factory that can produce 1,000 units, you're producing 600, and somebody comes in and wants to add another 200. You can see what is the effect that is that going to have on your bottom line, or how much you're going to have left over to cover your fixed costs. All right, so we're only going to use variable cost initially. The fixed manufacturing overhead is included as period cost. Now what that means is that the whole amount you spend on overhead is not, you're not going to assume some of it went to inventory like we do with absorption costing. We're assume that it all is deducted under variable costing. And I'll show you that in an example. Now again, this is for internal management only, but it often leads to better decisions because it shows you the incremental cost of manufacturing each unit, which is a great thing to know. Operating income will not be affected by changes in inventory levels, i.e. because it only looks at the costs that affect the sale. So what we're going to be looking at is what we call the contribution margin income statement. And what it's really saying is every time you make a sale, how much is contributed to covering your fixed costs. So they're organized by cost behavior. All variable costs are expensed above the contribution margin line. Remember that, including selling expenses. So we're not looking at, like we did with absorption costing, just cost of goods sold. When you do a contribution margin income statement, what we're doing is we're isolating our variable and our fixed costs. And it doesn't matter where they came from. All fixed costs are expensed below the contribution margin line. The contribution margin equals sales minus variable expenses. Remember that. Operating income is the same in both statements when all units are produced and sold in the same period, but in our example, they're not. And again, this is only for internal reporting. So what does that statement look like? You're going to show sales, then you're going to minus variable costs, gives you the contribution margin. That tells you how much you have to cover your fixed costs. Minus your fixed costs gives you your operating income. So now let's go back and look at our example and see what happens when we look at it. Look at the same information, but do a contribution margin income statement. So here's our example. And so what we have to do first in our example is pull all of our variable costs. So first, we're going to determine the variable portion of manufacturing overhead and total variable cost of goods sold per unit. I always like to do this first. So what we're going to do is take our total manufacturing overhead, which shows at 288. That's showing in the chart on the right side. We're going to subtract out the fixed portion, and that gives you the variable portion of the overhead. And we're going to, again, you divide by units produced, not units sold. Please do not make that mistake or you get everything wrong. Now, we're going to add to that our direct materials per unit, our direct labor per unit, and that tells us our variable cost of goods sold per unit is $32. Now we can do our contribution margin income statement. We start with sales, that didn't change, less our variable costs, and we have our $32 times 12,000 units. And remember, we also have our variable operating expenses of $1. Make sure you pay attention to that. And that gives us 12,000. So our contribution margin is 384,000. And now we subtract our fixed costs. And our operating income, as you can see, is different. It's 128,000, which is less than under absorption costing. Now, what do we look? They're saying, what is the product cost using variable costing? It is $32. What is the ending balance inventory for variable? It's going to be $32 times 4,000 units. It's 128,000. What is the cost of goods sold under variable? And actually, it's 384,000. What is the operating income under variable? It's 128,000. Now, here's something you can do when you're working a homework problem where they're asking you to do an absorption and they're asking you to do contribution margin income statements, and the units produced is different than the units sold. Do the reconciliation, because in the end, they have to be the same. So here's how you do that. So you're going to take, if the manufacturing goods are different, which in our example they are, you're going to have a difference in net income. If they're the same, your net income is the same regardless of what method you use, because you're not leaving that portion of fixed cost behind in ending inventory. So the difference in operating income is going to be the change in the inventory level in units times the fixed manufacturing overhead per unit. So let's do that. So net income under variable costing, or the contribution margin method. Now we're going to add to that the ending inventory, which was 4,000 units, times the fixed manufacturing overhead rate, which was our $14, which gives us $56,000. You add that together, and if you notice, it's the same net income that you got under absorption costing. I would do this as a check whenever I'm working those homework problems where you have a difference between what was made and what was sold. That ends part 1. And we have a part 2.